Daily digest on the screen at the moment. Welcome to the Daily Energy Markets podcast. It is September 11th, which is historically a massive day in the history of the world, I would say at this stage, but certainly in America and both to America and to British friends and colleagues who are sort of commemorating condolences on these days. Our thoughts go out to you all on that and your remembrance on this occasion. Let's get to the business at hand, which of course is the oil markets. We can review. We welcome back Christoph Ruhl, who was we missed last week. And I know Mike Muller certainly missed you, and he made that note and looks forward to being on stage with you again soon. Christoph, the volatility in the oil markets remains probably the defining feature. Since we had you last, we did have the intervention of the OPEC Plus into the markets to try, according to their announced reasons, to calm or try to do something to calm the volatility, which is seeing $3 and $4 moves each day on the average for the year, which is 3 times what it was last year. What are your thoughts on the outlook for that continuing and the consequences if indeed it does?
There's 2 things which continue in oil markets. One is the volatility you mentioned. The other is the downward trend. So we discussed this before. For a while now, it becomes obvious that at least the consensus forecast, whatever one thinks of it, but it forms opinions of traders, argues that in the second half of 2022, there will be an excess demand. Excess supply. There will be more oil than will be demanded. And it's visible that the situation there is pretty relaxed in this kind of downward trend around which this volatility occurs. At the same time, it's not yet the kind of situation where you want to put all your money on lower oil prices, because the inventory levels and spare capacity levels, so these layers of protection against disruptions, are still very, very thin. And any kind of political event or otherwise could lead to price spikes. But this is the downward trajectory around which we bounce. And now there's 2 important events coming up if you just look at oil markets in isolation. Number 1, the European Union boycott or embargo of crude oil imports on December 5 and of refined products on February 5. And number 2, the US proposal, which has been now signed off by the G7 to put a price cap on oil. And so these are the interesting questions I'm thinking about, because when you think of oil markets and energy embargoes and all of this, we have to always think about 2 things. One is the cuts in volume, which will make revenues lower for Russia and which will have this huge long-term implication that fields may be damaged as they produce less. And the second one is the cut in price, which is sort of more the immediate target people think about when they think about Russian revenues, which is a very difficult, should talk about a very difficult thing to do, because we already have a price discount for Russian oil in the market, and a dual pricing system with a global price on the one hand and a price for Russian oil on the other hand is something which is awfully difficult to administer and to implement, and dual prices in economics always spell trouble. So it may not be that such a good idea, but it's a separate discussion. But this is where we are: downward trend, high volatility, 2 big events coming up, one targeted at volumes, the other targeted at prices, and the joint outcome of the 2, I think, will be a continuation of the downward trends and probably a Russian reaction in the form of saying we cut exports. There is probably a big event coming with a price spike.
Let's welcome Dr. Lee Chen Sim, Assistant Professor at Khalifa University. Dr. Lee Chen is a specialist in the political economy of Russia and the Gulf energy and its intersection with international relations. So a perfect day, Dr. Lee Chen, to have you on. Let's start with the Gulf side of that expertise and this narrative that we was talking with Christoph about. The decision about OPEC Plus, and of course that features the UAE, Saudi Arabia, Kuwait, all the big Gulf oil producers, to interdict in the market in recent weeks, indicating some intention to defend $90 oil. Your thoughts on the decision and the political consequences that go along with defending such a high oil price?
Hi, thanks for having me, Sean. And before I answer that, could I just comment on what Christoph mentioned? I actually like to add a third events. You mentioned two, Christoph, so I'll add a third event that's coming up, and that's probably the elections in Italy. So that one is, with all the forming of the cabinet, etc., likely to see a far right controlled Italy. So that also will have consequences on, the two events, the price caps or the windfall taxes, the kind of European unity that's needed for all these actions. So that would be the third event. To come back to your question on the small increase, the sort of small decrease that OPEC Plus decided on, I think that's quite a good move in the sense that not that it's significant in any way to the market, but I think it's great in terms of an intention that they are actually, ready to cut supply. So I think that signals quite a good intention that there is at least some unity to try to at least, stabilize market prices, stabilize supply. And if there needs to be a further cut, maybe there could be appetite, but at least there's an indication that there is some willingness to think about cuts.
What, just to the second part of my question, Dr. Lee Chen, on that, the political consequences, because of course, it's only a few weeks ago that the President of the United States was in the region in meeting with all of the Gulf allies. For many reasons, that meeting took place. I'm certainly not advocating that the only reason was in which to discuss the oil framework, but ultimately, a big moment of time going into US midterm elections to take actions that would appear, if nothing else, to be pushing prices up or attempting to push oil prices higher. How do you see the dynamics of that playing out from a sort of Western perspective, given the duress that the economies are facing?
I don't think that it plays out very well at all in the West. Obviously, OPEC Plus may have its own reasons for doing that, but I think the optics of it is what the question is. The optics from the Western point of view is just not very helpful. The optics of the earlier votes supporting the or not condemning the Russian invasion in Ukraine would also not be a good optics. So I think the kinds of optics are very, very important in this case, and they will not be very useful for the Gulf states.
Christoph, I'd like to just go ahead.
No, just to add to that, this is more than optics. So this will come back to haunt this region, this behavior. I think it's very clear OPEC wants high prices, not stable prices. And the last thing they want to lose is the plus. So the last thing Russia needs is low oil prices. So there's a joint effort to keep them up.
It starts to feel a little bit like the Gulf states coming off the fence of neutral posture regarding the whole Ukraine war, Russia's war in Ukraine, by sort of moving into such a more aggressive posture and defending oil prices at this time could be perceived as coming off the fence in favor of Russia. Christoph, just to speak to that and to the point you made in your closing of your first comment there about the likelihood that Russia moves to cut oil supply and create a spike, a shock, as they have done on gas, not waiting for what the Europeans have already declared, that in December they will boycott all marine bound oil exports out of Russia will be barred from Europe, but that the Russians may move earlier as they have done on gas. Your thoughts on what could inform that move?
Let me start because it's a good example for this with the gas market. In gas, we have the situation that Russian pipeline exports to Europe can only go to Europe. And through this whole back and forth of which we are all familiar with now, these exports are down to at least, maybe less, but at least 1/4 of what they used to be. The European Union used to consume 40% of its oil from Russia. Now it's down to 9%. So that's about 1/4 of the Russian pipeline exports there. That market is probably lost for good. And it will take years for Russia to redirect this gas somewhere else because they need to build pipelines first. And that explains, I think, this aggressive attitude where there's little doubt in my mind that with this leftover quarter, they will play with it in the winter and use it to cut off, to put pressure on Europe, to get people on the streets, to create the kind of social tension we urgently need. In oil markets, it's more tricky, but comparable in a way. Oil market exports for Russia, there's one big question mark, and this is this hypothesis: how much can they lower it without suffering damage to the fields, which would be very difficult to repair without foreign investment in technology. Some people say, anything lower than 2 million cut, so it's dangerous for the fields. Some people say the bench line is much closer. The historical data we have is that there is a problem when the oil production collapsed after the Soviet time. It took more than a decade and a lot of investment to bring them back up to previous levels, because these fields are so different from Middle Eastern fields. They have so many different wells, not one big one, so that the water cut increases in different places. And it's just complex system, which is hard to restore. So given that, and given the OPEC tendency, which becomes apparent to keep Russia in the fold at almost all costs, the consequence logically would be that somebody else does the cutting, and keeps the oil price where it is and keeps Russian exports high and flowing. If that is to happen, I think then this would be really perceived as some almost hostile act in this kind of economic warfare by the US and by the West. So we cannot confidently predict it, but it's certainly the train seems to be moving into that direction. And then to your question, now you have the background. You have this region sort of coming off the fence a little bit, not joining the sanctions, doing a lot of financial sector business with Russia, no doubt. Everybody knows it. Once the situation is over and it comes to negotiations with Iran and all of that, we're much more likely to be back in an Obama world of saying, you guys take care of your own business, than getting closer to a Trump world, which comes and embraces the region. I think this will have consequences which might be more serious than we realize today. On the oil market side, the pressure on oil markets will continue. The price cap will be very important, the level at which it is set. Is it above or below the discount which we already have? That will determine where the train is going there on the revenue side. But just one last sentence, we should also not lose context. All of this happens just at the moment when on the military side, things are not turning very good for Russia. And it becomes very apparent that their troops have low morale and all of that, and Ukraine is advancing. So deciding with Russian needs for oil revenues may come at a completely wrong time, on top of everything else, on top of being the wrong decision.
Dr. Lee Chen, we have the headline in our digest today with the article from Energy Intelligence that simply says all-out energy war, that this conflict between Russia and Ukraine is now an all-out energy war with the whole of Europe, if not other parts of the world as well. But we're getting, and obviously we can very clearly see the impact it's having on Europe and the European economies. What's not so clear is the impact that it's having on Russia. We had President Putin last week saying, nothing to look at here, all is well. What's your own assessment of the scale in which Russia, clearly they have all the food they need, they have all the energy they need, but in terms of the impact on the Russian economy 6+ months now into this war, how is your reading on their ability to endure another 6 months?
It's a great question. And I think, yes, you're right that Putin came out to say, everything is not too bad, GDP will drop, but, maybe by about 2%. So it's not, not super disastrous. But I think he has to say that, right? I mean, he is the leader and, he did invade Ukraine. And so hence he's got to put some kind of spin on it. But I think if you look at the IMF reports, if you look at even the own central bank reports or the Ministry of Economy reports, those drop in GDP figures are much higher, something like between 4% and 6%. So, I think that there is an attempt to put a spin on that. We have reports of Russian capital trying to leave, or even Russians voting with their feet and leaving the country because of business reasons or political reasons. And also, of course, the automotive sector being affected by the shutdowns. So I think that there is some, obviously quite a big effect, but, as to gauge it with hard data, you have to see, which source you're using. But, I would say that there is conflict among economists on how badly sanctions are affecting Russia, but it is definitely affecting Russia. Although to what degree, is it to the degree that the West would like to see Russia being hit in retaliation for its actions, then that's a different question.
Christoph, looking into last week, bridging into next week, we had the European Central Bank take its biggest move on interest rates for, I think, perhaps ever on one singular step, 75 basis points. We have the UK Central Bank expected to increase again this week. And then the week after that, we have the Fed, all of it moving into a much bigger trajectory of scale of rate hikes, right? 50 from what were 25 to now 50 and 75 basis points. I'm wondering, and we had last week after the ECB made that move, stock markets actually rose. I mean, talk about counterintuitive outcomes. Where do you see the trajectory of the rates going and their consequence and impact for the respective economies?
So I found that actually very encouraging, the stock market reaction. There is this old saying, if you have to cut the tail of the dog, you better do it with one cut, not with piece by piece. I think what we will likely to see is another big rate cut by the Fed, much less activity going forward with the ECB, because they have to deal with this very heterogeneous group of countries in different stages of crisis. But the key to what happens, this whole political situation with Ukraine and Russia, is also in Europe now on the economic front. If they can sustain their energy and other sanctions throughout the winter without generating big protests, and that requires to get control over inflation and to at least appear to be seen, to be decisive and to be confident and to be, they are based on a much stronger economy. Russia, for Christ's sake, the economy is smaller than Italy. Nobody worries about the Italian economy in the world. So why do we make such a big fuss about it? And to take some of that shine away, it requires decisive action. And I personally sort of welcome this. I think that we will see that the Europeans, at least Central Europeans, Germany and elsewhere, are holding up well with these sanctions. They're not going to cave in and not just lock on Nord Stream 2 or something like that. They will freeze maybe a little bit. But I also think that they can avoid a terrible recession, because, as you once said, in the US and in Europe, we're both in a situation that a recession, even if it comes, is a technical, term of 2 declines in GDP, but it might be quite shallow. You can have recessions with 20% unemployment, and you can have them with 5%, and this one looks more like 5%. And then, if they hold steadfast during the winter, if the energy markets have time to react to this price and volume constraints and to reorganize themselves, then what we will see is energy prices coming down, and that means headline inflation coming down, and that means the ECB and others, the Fed, being able to declare victory, and that means this confidence boost sort of going reinforce itself. And one word on the Russian economy where I disagree, it's not all fog and impossible to see. There's agreement that is being hit severely, and you can see this, they can't even produce their own rockets anymore. If you have to buy millions of shells in North Korea, how bad can it get? But there's
and drones from Iran.
Yeah, exactly. So this is not in great shape. And there's agreement on one thing, which is that the longer the sanction lasts, the more it grinds it down. So it's clearly on a downward trend. And in the West, we have, the longer now this winter will be sort of behind us, the more it will go up. So we have this contrast becoming stronger. We see, already the first half of this year, 400,000 Russians, according to official statistics, left the country. So this is moving. This whole situation is moving in favor of the West, of the collective West.
Christoph, just to speak, the other obviously growing concern in Europe is the contagion issue. Recession is one of the issues, obviously, and gas shortage. But now we have the contagion issue in terms of utilities going bankrupt or not being able to meet their margin calls, and the consequence of a financial crisis stemming from that. Can you just speak a little bit to that? There's a lot of reporting in the media over the last few days regarding that, and countries looking to bail out their utilities.
Yeah, so it's also, it's one important that one gets sort of understands the basics, and the basics are that we have competitive electricity markets in Europe where the price of electricity is determined by auction. And that means that the price of everybody's electricity essentially is determined by the last unit which was brought online, and that's the most expensive unit, comes online last. And currently that is gas. So that means that if the gas price goes up, the electricity price goes up with the marginal cost for everybody. And everyone who can produce cheaper electricity with renewables or with coal or with nuclear power makes a tremendous tremendous amount of money because now the the electricity price is much higher than the price for its coal or wind. And so on. In that situation, there's exactly two things you can do. You can cap the price for either electricity or gas in order to keep prices low and to protect your industry and your people, or you can tax the windfall of those cheaper producers and use that money to transfer it to consumers and industry. And this is the question Europe was struggling with. None of it is ideal because on the one hand, you want high price, you don't want to distort the general price. It's better to have transfers to household and industry and keep high energy prices because you want them to save energy and to use less energy. And you want general prices to reflect that. On the other hand, the system is so far out of kilter with electricity prices 10 times what they are normally on average that it really doesn't make a difference whether they're 8 times as high or 10 times as high as they are in normal times. So people say, let's just cap the prices. And I think we are now moving towards a direction where they are moving towards windfall because maybe the instinct of the European Union is more towards taxation and redistribution. It would have been easier to just cap the price of gas, but not at the utility level, at the Russian import level. We just tell the Russians, we're going to give you X amount, and if you don't want to, but that would have triggered an immediate shut off of the gas. That's what Putin clearly said. So that option was taken off because they were, not willing to risk a complete shutdown. And so now what is going to happen is that companies are going to be taxed and that the windfalls are going to be distributed to households. An example how not to do it is the UK. Everybody gets £400, whether he's a CEO or a beggar. That's clearly not effective. But maybe better examples can be found. This is war. So you have to do these kind of things, these interferences. What matters is that they protect industry, protect consumers to the extent to avoid unrest. And what matters is that after the war, the economic war, that these measures are swiftly withdrawn, that we don't end up in a situation with, nationalized utility companies, basically.
Well, back to the way they were, perhaps. Let's get the survey question in because I wanted to get a post on social media today. This idea that Putin will cut off Europe from Russian oil as he did from gas before Europe has a chance to do the opposite, right? Europe currently has a policy in place to cut off seaborne oil imports from December. But my question is, will Putin cut off Europe before then from Russian oil as he did from gas? And this spike in the oil markets that Christoph referenced earlier that could be coming, even though we are in a downward, what seems like a downward motion from oil prices, which Brent dropped below 90 last week for the first time in 6 months. Dr. Lee Chen, we of course have the ongoing uncertainty in the energy markets around the Iran nuclear agreement or lack thereof. What is your own sense of where that is at this time? Is it viable that this deal could still be made before the US midterm elections?
The Iran deal, well, as you know, there are many views on that. My own personal view is I cannot see it being done before the midterm elections. I think there's just too many ifs and buts. Obviously, for the world energy markets, it will be useful if it was done, so it can ease some of the pressure of world energy markets, given that Iran supposedly has oil ready to go stored in the ships, in the sea. So that would ease energy markets. But I just think that there are too many ifs and buts. The world is too distracted with having to deal with the war in Europe. And so I just cannot see it getting done anytime before the midterm elections.
I wanted just to follow up on that, because what I've lost a sense of is where is this region in the Gulf on their views. Clearly, at JCPOA 1 in 2015, the Gulf states were very displeased with the developments around that agreement. On this occasion, it looked like they had everybody on side with the return of the UAE ambassador to Tehran. But now I'm not so sure. What's your own sense of where the geopolitics of the neighborhood is regarding support of this deal getting done?
From where I'm sitting here in Abu Dhabi, I think that they're kind of in a conundrum, as you rightly pointed out. On the one hand, these states, Saudi Arabia and UAE, are looking to try to reduce tensions in the region with Iran, with Turkey, etc. But on the other hand, I think there's a realization that if the JCPOA does come on stream, then that means that they would have to deal with the Iranian oil output, which would mean it's even more difficult to control oil supply and prices for that matter. So I think they're kind of in a conundrum about that. And, we'll have to see where it goes.
Christoph, we have a few things to look for next week in the coming week. One of the things that I'm going to be watching is the meeting between Vladimir Putin and Xi Jinping, the first of the meeting of these two gentlemen since the war in Ukraine. And obviously that very now in a historical meeting between the two leaders around the Beijing Olympics. Now, what does that look like? What do you think both the sort of optics of that will be? Will they play it up? Will they make it into big? Will it be small? What's your own sense of how important it is?
It's terribly important. The optics will just will show a grand meeting, of course, but China emerges as one of the sort of winners out of this situation here, apparently. And if somebody sits on the fence, it's China. It's very interesting that if Russia has problems with sourcing enough ammunition, and so the Chinese have not delivered that, despite all the words of a big friendship here. China watches that conflict from different angles, and China also. But let me start at this military side. So Putin clearly has a problem now in the Ukraine, and this has a lot to do with the moral of his troops. And before declaring a general sort of state of war or emergency or mobilization, he has problems refilling these unreliable troops there. And that will not have escaped the Chinese attention. At the same time, they're starting to do maneuvers with China. And China must be wondering how reliable an ally this is there. Then on a completely different front, China, Xi Jinping is about to be confirmed as the first leader after Mao who stays in office more than 2 terms at this Congress, which is coming up in a still secret date in October, November. And China holds, in a sense, the key to the global economic recovery of the world, because when China, as people expect, starts to stop its corona lockdown after this, you're frozen. Can you hear me?
Yeah.
Just continue. Stops to loosen up and giving up on its zero COVID policy, then there's much more chances for a global recovery than under current circumstances where China is just dragging down the global economy. So there, China is important as well. And I think this will be a meeting where they, much less confidently than a few months ago during the Olympics, are sort of testing the grounds for future collaboration and for this new geopolitical map which emerges following the failure of Russia in the Ukraine, which is on the horizon, and following the dire economic situation in China, which must have come as a surprise to Xi Jinping.
Let's get the survey question and give Dr. Lee Chen the last word. Yes, please go ahead. Final word to you, Dr. Lee Chen. Yep.
No, just to jump in there, you asked about the meeting. So I just wanted to say that I think it'll be very interesting to watch the official reactions from the meetings, the readout of transcripts, because you might see that Russia is maybe putting on more of a bravado when they release the release from the press conference, whereas the Chinese may actually play down the meeting a little bit, not talking so much about the greatness of the so-called alliance. So I think that you could see that discrepancy there, and that would be interesting to watch.
Well, we're going to have to wrap it up there. Certainly, every week is delivering no short list of dramas, and we will keep an eye out on them all. It's which of them are most significant for the direction of travel of the oil markets. Of course, I think it's increasingly hard to say, but demand destruction and recession outlook seems to be the biggest sort of weight at this time. Let's see what happens. Thank you so much for your contributions today, Dr. Lee Chen Sim and Christoph Ruhl. Really appreciate your insights this Sunday morning, the 11th of September. Have a great week, everybody. All the best.
Thank you.